Let's just dive right into this explainer and completely demystify how massive computer programs execute trades in fractions of a millisecond, literally without any human intervention. We always hear about algorithmic trading, right? The computers that basically run Wall Street. But how do they actually work? How does a machine go from just a string of code to buying and selling millions of dollars in the absolute blink of an eye? Well, today, we're going to break down that exact ecosystem. By the end of this, you're going to have a really comprehensive, gap-free understanding of the architecture, the math, and the rules that govern modern automated markets.
To do that, here's the exact lifecycle we're going to cover: building the engine, rehearsing the strategy, the logic of profit, executing secretly, and finally, the regulatory guardrails.
All right, part 1, building the trading engine and the event-driven architecture. Let's get into it.
So our engine relies on treating every single market action as an instant event. Think of this setup kind of like the anatomy of our bot. First up, the market data reader. This acts as the eyes, constantly ingesting live price updates from global exchanges. All that data flows right into the centralized storage, which is essentially the memory, recording those prices right alongside account balances and historical trends. Next, the info enters the strategy pipeline. This is the brain of the whole operation, analyzing that incoming data to decide exactly when to buy or sell. And finally, once it makes a decision, it goes to the broker interface, the hands, if you will, which translates that decision into a digital order and fires it off to the market.
Now, when you're dealing with fractions of a millisecond, even a microscopic delay in just one part of the system can completely scramble the data. Without a fix, a bot might actually try to sell an asset before its memory has even registered buying it. So to solve this chaos, we use a sequenced stream architecture. It acts as this master metronome, absolutely guaranteeing that every single component of the network processes the information in the exact same chronological order. This absolute, pinpoint accuracy is completely non-negotiable for the system to function safely. Okay, moving on to part 2, rehearsing the trading strategy and backtesting the logic. Look, you never put on a Broadway play without a dress rehearsal, right? And you definitely don't unleash a trading bot risking real capital without seeing how it would have performed in the past. But before we test, we have to face a really messy real-world challenge called slippage. Slippage is simply the difference between the expected price of a trade and the actual price you pay in real life. Why does this matter? Well, by the time your bot decides to buy an asset at, say, $10, it takes microseconds for that order to actually process. In that tiny little window, the price might have jumped to $10.01. Our backtesting absolutely must account for this messy reality.
Because of this slippage, researchers use 2 entirely different methods to test their logic. First, they use vectorized backtesting. This method applies mathematical formulas across massive historical datasets all at once. It's incredibly fast, letting researchers rapidly brainstorm thousands of ideas. But, and here's the catch, it entirely ignores those micro details like slippage. So, for the final, realistic safety check, they must use event-driven backtesting. This method is computationally much slower because it feeds historical data into the system one tick at a time, exactly as it would happen in live markets, perfectly simulating those real-world delays. Basically, you use the fast method for brainstorming and the slow tick-by-tick method for your absolute final safety check.
Which brings us to part 3, the logic of profit. This is where we teach the bot to actually make money. Here, we map 3 core strategies to their required market conditions. Because, different environments require completely different mathematical logic. First, in a highly volatile, fast-moving market, bots use a trend-following strategy. It assumes an asset moving strongly in one direction is just going to keep doing so, essentially catching a wave and riding the momentum. But if the market is stable and predictable, the bot switches to mean reversion. This strategy mathematically believes prices always return to their historical average. So if a price takes a sudden dip, the bot buys it, confidently expecting the price to bounce back up to normal. Finally, we've got arbitrage. This relies on temporary pricing gaps across different global exchanges. If the exact same asset is a tiny bit cheaper in London than in New York, boom, the bot buys the cheaper one and instantly sells the more expensive one. Now, to understand our final strategy, we first need to know what a spread is. Simply put, the spread is that tiny, tiny gap between what people are willing to pay for an asset and what others are willing to sell it for. By constantly capturing this tiny spread, market-making algorithms actually provide vital liquidity to the broader market. Instead of betting on the direction of a price, a market maker continuously offers to both buy and sell an asset simultaneously. They make a microscopic profit on that spread. But because they do it literally millions of times a day, it adds up to massive profits. And what you should really take away from this is that these bots actually provide a huge service. They ensure humans and other algorithms can always easily buy or sell whenever they need to, purely because the market maker is always right there offering a trade.
All right, part 4, executing the trade secretly, and the mechanics of buying and selling.
So deciding what to buy is really only half the battle. If a bot tries to buy 1 million shares all at once, that massive surge in demand instantly drives the price up, causing the exact self-inflicted slippage we talked about during testing. To prevent this, execution algorithms secretly slice massive orders into completely invisible pieces. Let's look at 3 ways they hide. The VWAP, or volume-weighted average price algorithm, hides in the natural volume. It analyzes normal daily rhythms and trades its sliced pieces in exact proportion to that rhythm. Then there's the TWAP, or time-weighted average price, which is a bit simpler. It completely ignores volume and just deploys small pieces at steady, timed intervals like clockwork. But sometimes hiding isn't the priority. If an opportunity is about to rapidly disappear, the algorithm uses the implementation shortfall method. This intentionally accepts a little market impact, trading aggressively upfront just to grab the asset before the window closes.
Another super powerful execution method is the percentage of volume, or POV algorithm. As you can see, it dynamically adjusts its trading speed to ensure our order is always just a tiny, camouflage slice of the market's total pie. If the overall market suddenly starts trading really quickly, the algorithm speeds up to maintain its exact 5% slice. If the market slows down, well, the bot slows down too. It perfectly blends in with the crowd at all times.
Finally, we arrive at part 5, guardrails of the financial system and the regulatory framework. Because these machines can place thousands of orders a second, a single tiny bug in the code could execute millions of bad trades and literally trigger a broader market crash. To protect the public, we actually see contrasting global approaches to regulation here. In the United States, SEC Rule 15C3-5 mandates strict digital safety nets built right into the software to prevent erroneous orders or, trading more money than the firm actually even has. Europe's MiFID II regulations, however, go even further. They require incredibly strict data logging, forcing firms to store a time-sequence record of every single algorithmic decision for 5 solid years. Furthermore, MiFID II uses anti-panic contracts. If a bot acts as a market maker, it must sign a binding contract promising to continue providing liquidity even during a crash. This essentially ensures the financial system doesn't just freeze up because the machines get scared and turn themselves off.
So there it is, the completely demystified ecosystem. Let's do a quick recap of this assembly line to really solidify what we've learned. We start by building the event-driven engine to instantly process live data. We then safely rehearse the logic using vectorized and event-driven backtesting. After that, we deploy mathematical strategies like mean reversion or arbitrage to target the profit. We use execution algorithms like VWAP to hide our massive trades. And finally, we satisfy strict global regulations to ensure these automated actions don't inadvertently break the economy. It is a beautifully logical, sequential intersection of computer science and financial theory.
It's an incredibly powerful system that makes our modern financial markets possible, but it does leave us with one really fascinating thought to take away. As these algorithms become smarter, faster, and just more prevalent, who is really in control of the market now? And more importantly, what happens when they all look at the data, arrive at the exact same mathematical conclusion, and all agree to make the exact same trade at the exact same millisecond? We saw glimpses of this during the 2010 flash crash, and as the bots get smarter, it's the trillion-dollar question hanging over Wall Street.